So I want you to imagine for a second that you run a massive business,
Okay, I'm picturing it.
right? And over the course of a year, you managed to grow your sales by, you know, a very respectable 15%.
Which is a solid year.
Yeah, exactly.
Yeah.
In the heavy manufacturing world, that is a huge win. But then you look at your actual profits, the money you actually get to keep.
Right, the bottom line.
Right. And those profits didn't just grow by 15%. They skyrocketed by over 56%.
Oh, wow. Yeah, that's wild.
It's nuts, right? I mean, in heavy industry, growing your profits almost 4 times faster than your sales, well, that usually requires some kind of financial miracle.
Or some really creative accounting.
Right. But what if all it took was treating a multi-billion-dollar infrastructure company like a giant Kickstarter campaign?
I mean, it sounds completely counterintuitive when you frame it that way.
Yeah.
But when you actually strip back the layers of the data we're looking at, that is exactly what is happening here.
It really is.
It's basically a masterclass in making your own customers finance your growth.
And that is the exact mechanism we are going to, reverse engineer for you today on this deep dive.
Yeah, we've got some really interesting numbers to go through.
We do. We have a pretty hefty stack of financial data in front of us. Specifically, we're looking at the 2025 Consolidated Annual Report for Electrical Industries Company, or EIC.
Right, they're a massive Saudi joint stock company.
Yeah. Now, I know that diving into corporate financial statements can sometimes feel like trying to, I don't know, translate ancient Greek while blindfolded.
Oh, absolutely. It's incredibly dense stuff.
Yeah, but our mission today is to cut right through all that heavy accounting jargon. We really want to extract the core story of EIC, what they actually do, who's paying them to do it, and the underlying mechanics of why 2025 was such a financially explosive year for them.
Because what's fascinating here is that the 2025 report doesn't just show us a company having a good year. It reveals this fundamental shift in their operational efficiency. I mean, they aren't just selling more stuff. They have completely rewired how cash flows through their entire business.
Okay, so let's unpack this from the ground up. Because before we can appreciate the explosive profit growth, we really have to understand the physical reality of the business itself.
Exactly.
So what is EIC actually building? Like, how are they making their money?
Well, to understand EIC, you have to split their business into two main segments.
Okay.
The first, and by far the largest, is manufacturing, assembly, and supply. We are talking about the sheer heavy lifting of the electrical grid.
So not small electronics.
Oh, no. They manufacture massive transformers, compact substations, low-voltage distribution panels, cable trays, and switch gears.
Right. And, for those of us who aren't electrical engineers, what does that actually mean in the real world?
It basically means they build the critical, heavy-duty hardware that literally keeps the lights on in cities, industrial complexes, you name it. When a power plant generates electricity, it travels at dangerously high voltages.
Right. You can't just plug a toaster into that.
Exactly. EIC builds the massive metal transformers and substations that step that voltage down, and distribute it safely to factories, neighborhoods, and eventually right into your living room.
Okay, so serious heavy metal infrastructure.
Yeah.
Definitely don't just order one of these on Amazon Prime.
No, you do not. It requires massive industrial facilities just to build them.
Right.
Now, the second segment of their business is services.
Okay, what does that cover?
This involves the more technical side, so the installation, the repair, and the ongoing maintenance of all that heavy equipment they just manufactured.
So if we think about this like the auto industry, EIC isn't just selling you the heavy-duty commercial truck, which would be the manufacturing side.
Right.
They are also running the exclusive certified mechanic shop to keep that fleet of trucks on the road, which is the services side.
That's a great analogy, actually.
But looking at the data here, the sheer difference in scale between these two operations is just wild.
There really is.
Out of their $2.29 billion in total revenue for 2025, a staggering $2.18 billion came strictly from manufacturing.
Yeah.
The services segment brought in about $110 million.
Which is a brilliant strategy when you really think about it.
How so?
Well, the heavy iron is obviously what drives the massive revenue, but that smaller service segment, that is pure strategic lock-in.
Ah, right.
Once a client buys a multi-million-dollar substation from EIC, they are essentially tethered to EIC's ecosystem for maintenance and repairs for the next 30 years.
Because nobody else knows how to fix it quite like the people who built it.
Exactly.
Okay, so building these massive heavy metal transformers, It obviously requires incredible upfront capital, raw materials, huge labor forces.
Definitely.
So the next logical question you have to ask is, whose wallet is actually funding all of this? Like, who is writing these billion-dollar checks?
Well, if we break down the 2025 customer demographics, the geographic story is overwhelmingly domestic.
Okay.
The Kingdom of Saudi Arabia accounts for over 2.05 billion of their total revenue. They have absolute dominance in their home market.
Makes sense.
But they are also pulling in about 174 million from Europe and roughly 65 million from other Gulf countries.
Which, it makes sense to dominate your backyard first.
Yeah.
Especially when your backyard is undergoing a massive infrastructure boom right now.
Exactly.
But here is where the data completely defied my expectations, honestly.
Oh.
Given that they build massive electrical grid infrastructure, you would immediately assume their biggest customer is the government, right?
I think so.
Yeah, you picture state-owned utility projects and municipal power grids. But the data shows something completely different.
Yeah, it is easily one of the most surprising details in the entire report.
It's wild.
Despite the public nature of power infrastructure, the overwhelming majority of their revenue actually comes from non-government or corporate clients. We're looking at 1.9 billion from corporate clients versus roughly 389 million from direct government clients.
Okay, but I have to push back here a bit because I was digging into the notes on their trade receivables, which are basically the IOUs from their customers.
Right, the money owed to them.
Yeah, and I noticed a detail that honestly made me blink twice. They have one single, whale of a customer that accounted for almost 367 million of their manufacturing revenue in 2025.
That's a huge chunk.
And that's up from 288 million the year before. And even crazier, just two customers account for 24% of all their outstanding IOUs.
Mm-hmm.
Isn't it incredibly risky for a company to have a quarter of its outstanding cash tied up in just two clients? What happens if one of them suddenly defaults?
Well, you're pointing out a classic vulnerability. I mean, in financial analysis, we call that concentration risk.
Right.
When your revenue is that top-heavy, a single hiccup with one client can absolutely send shockwaves through your entire balance sheet.
Exactly. 24% is a huge exposure to just two entities.
It is. But if we connect this back to the historical context provided in the report, EIC manages this risk deliberately.
Okay, how?
Well, the corporate landscape in Saudi Arabia is pretty unique. Many of these massive corporate clients are likely pseudo-state entities or massive industrial conglomerates with, deep, deep pockets.
Oh,
EIC isn't extending hundreds of millions in credit to, unproven tech startups. These are highly capitalized entities with very established track records of timely payments.
sure, I get that they are highly creditworthy right now, but we are talking about heavy industry in the Middle East,
Yeah.
where macroeconomic conditions and, geopolitical shifts can happen literally overnight.
That's true.
Can a spreadsheet's historical credit model really account for a sudden regional crisis? I mean, if supply chains freeze and one of these mega corporations suddenly can't pay their bills, past performance doesn't mean much.
That is a very fair point. And frankly, it's a systemic risk you simply cannot fully erase when operating at this kind of scale. But to EIC's credit, they do acknowledge this reality. They don't just blindly trust these clients to pay up.
Do they have a safety net?
Yeah, the report shows they have proactively set aside a $28 million rainy day fund, what accountants call an impairment allowance, specifically to cover potential bad debts.
Okay.
But you are right. If a true black swan event hits their top two clients, $28 million won't plug a hole that big. It's a calculated gamble.
It's fascinating. They are betting big, but they are betting on the absolute biggest players in the room.
Exactly.
So we know who is writing the checks, which explains the top-line revenue.
Yeah.
But a bigger check doesn't automatically equal a bigger bank account at the end of the year.
Definitely not.
Let's look at what actually happened in 2025, because this is where the business transitions from just being large to being incredibly lethal.
The efficiency gains here are truly remarkable. We are really looking at a masterclass in margin expansion.
So let's translate that margin expansion for you, because the numbers here are the big aha moment of this deep dive.
Right.
EIC's total revenue grew by about 15.5%. going from 1.98 billion in 2024 to 2.29 billion in 2025.
Solid, respectable growth.
Very solid. But then you look at the net profit. the actual money attributable to the shareholders,
Yeah.
and it skyrocketed by over 56%.
Which is just incredible.
It jumped from roughly 401 million to nearly 630 million. So how do you pull that off? Like, how do you grow your profits almost 4 times faster than your sales?
It looks like magic, but it's actually the result of some very aggressive, very smart mechanical tuning of the business.
Okay.
There are three primary drivers behind this profitability surge. The first is a concept called operating leverage.
Operating leverage. Okay, so basically you're saying it's kind of like chartering a bus.
Okay, go with that.
Whether you have 10 passengers on the bus or 50 passengers, you still have to pay the driver, you still have to buy the gas, and you still have to pay for the bus itself, right?
Right.
So passenger number 51 is almost entirely pure profit because your base costs are already covered.
That is the perfect analogy. Operating leverage happens when a company can increase its sales without its underlying fixed costs increasing at the same rate.
The bus is already running.
Exactly. The bus is already running. In EIC's case, while their revenues surged by 15.5%, their cost of sales, so the raw materials, the factory overhead, the direct labor, only went up by about 8%.
Wow.
It went from 1.30 billion to 1.41 billion.
So they sold significantly more products, but it didn't cost them proportionally more to build those extra transformers. The factory was just running way more efficiently.
Precisely. That widening gap between the revenue they bring in and the cost to manufacture the goods, well, that falls straight to the bottom line.
Makes sense.
But that's just the first driver.
Yeah.
The second driver is that they actively trim the fat in their operating expenses.
How so?
Usually, when a company sells 15% more physical product, their selling and distribution expenses naturally go up.
Right. You'd pay more sales commissions, you pay for more freight trucks, you do more marketing.
Exactly. But EIC's selling and distribution expenses actually dropped by almost $10 million.
Wait, really?
Yeah, they went down from $79.1 million in 2024 to $69.7 million in 2025.
Wait, I need to pause you right there. They shipped hundreds of millions of dollars more in massive heavy iron equipment, but they spent $10 million less to ship and sell it.
I know, it sounds impossible.
How does the physics of that even work?
It speaks to just incredible logistical efficiency. When you dig into the breakdown, you see a significant drop in freight costs specifically. When you reach a certain scale, especially dominating a domestic market like KSA, you can renegotiate your logistics contracts. You optimize your delivery routes. You basically stop sending half-empty trucks. They became vastly more efficient at getting their products out the factory door.
That is seriously impressive. Okay, so we have the bus running efficiently, and we are somehow paying less for the gas.
Yeah.
What's the third driver?
The third driver, and this is perhaps the most dramatic one for their profit margins, is how they absolutely crush their debt cost.
Oh, give us the numbers on that, because debt is usually the anchor dragging down heavy manufacturing.
Exactly. Building factories and buying raw steel requires loans. But EIC's total finance costs fell from $33.7 million in 2024 down to just $14.9 million in 2025.
That's less than half.
And the core reason for that drop is the actual interest paid on their borrowings absolutely plummeted. In 2024, they paid $22.7 million in borrowing interest.
All right.
In 2025, a mere $2.4 million.
Let's put that in perspective for you. They wiped out $20 million in interest payments.
Yeah.
That is $20 million that previously went straight to banks, which is now dropping directly into the pockets of their shareholders as pure profit.
Which is fantastic for them.
But if their interest payments fell off a cliff like that, they must have paid off a massive amount of the principal debt, right?
Yes.
But wait, if they're building more transformers, expanding their operations, and paying off massive loans all at the exact same time, where on earth is all this cash coming from?
That is the multi-million-dollar question. And the cash flow statement paints a picture of a company just swimming in liquidity right now.
Okay, lay it out.
To answer your question directly, yes, they aggressively paid down debt. In 2025 alone, EIC paid off $144.1 million in borrowings.
Wow.
If you look at their short-term Yurabaha borrowings, which is a common type of Islamic financing structure that acts very much like a standard corporate credit line, it is now down to just $15 million.
And what was it before?
The year prior, it was over 66 million.
That is a massive deleveraging in a single 12-month period.
It gets better.
Really?
Yeah, despite paying off all that debt, their actual cash pile grew. Their cash and cash equivalents almost doubled, jumping from 188.9 million in 2024 to a massive 350.3 million by the end of 2025.
That is staggering.
And just to prove to the market how much excess cash they were generating, they heavily rewarded their shareholders. They paid out 280 million in dividends in 2025.
He's way up, right?
Up significantly from the 196.5 million they paid out the year before.
Okay, my head is spinning a bit. They paid off a mountain of debt. They literally doubled their cash reserves. They paid out massive dividends, and they funded a 15% growth in their heavy manufacturing operations.
Yep.
I was staring at this balance sheet trying to figure out the secret behind this hidden engine. And then, well, I found this one incredible line item: advances from customers.
And there it is. That is the linchpin of their entire working capital strategy.
It's absolutely wild. In 2025, EIC held over $662 million in customer advances.
It's a huge number.
That is up from $474 million the year before.
Mm-hmm.
When you translate that raw number, it means they're sitting on over $500 million of their customers' cash before they even deliver the final product.
Exactly.
That's not just a deposit. That is essentially a massive interest-free loan from their own buyers. It's the ultimate corporate Kickstarter campaign.
It fundamentally flips the traditional manufacturing script.
Right. Because normally, a company like EIC would have to go to a bank, take out an expensive loan at high interest rates, buy the raw steel and copper, spend 6 months building a massive transformer, deliver it, and then hope the customer pays the invoice in 90 days.
Exactly. But EIC has engineered what we call negative working capital.
Right.
Their customers, those highly creditworthy corporate whales we talked about earlier, are essentially funding the entire manufacturing process up front.
They inject hundreds of millions of dollars of interest-free cash into EIC's bank accounts. This allows EIC to operate essentially debt-free on the backs of their clients' cash.
Precisely.
That explains everything. That explains how they wiped out their interest expenses, how they funded their growth, and how they artificially boosted their profit margins. It's brilliant. But, I mean, how do they convince their customers to agree to those terms?
Well, if we connect this back to the broader market, it really demonstrates immense pricing power and market leverage. You can only demand $662 million in upfront cash if you produce a critical, highly specialized product that your customers desperately need and, crucially, cannot easily get elsewhere.
Right, if you're the only game in town.
Exactly. If a corporate client in Saudi Arabia wants to build a new industrial city, they need power. To get power, they need substations. EIC is the dominant player who can deliver that at scale.
So EIC dictates the terms.
They do. They have effectively outsourced their own financing costs to their customer base. That is the hallmark of a highly optimized business monopoly.
So let's bring this all together for you. What we've uncovered in this report is that EIC has built a highly efficient self-funding machine.
Very much so.
By dominating domestic infrastructure manufacturing, securing massive upfront cash advances from a reliable corporate client base, and then aggressively using that cash to pay down their expensive bank debt, they managed to turn a solid 15% revenue bump into a massive 56% profit surge.
It's incredible execution.
They are printing cash, paying out huge dividends, and running a lean, mean operation where their own customers basically act as their bank.
It is a beautiful financial model. But
there's always a but.
There is always a but. Because as perfectly tuned as this financial machine is on paper, we have to remember that EIC does not operate in a spreadsheet.
Right.
They operate in the physical world. And the physical world carries physical and geopolitical risks that a brilliant cash flow strategy just cannot completely insulate you from.
You're talking about the fine print now. What specifically caught your eye at the very end of the report?
There are two very distinct notes buried deep in the auditor's disclosures. First, Note 20 highlights a new $12.3 million soil remediation provision.
What's that about?
EIC's subsidiary in Belgium recently bought a property they had previously been leasing. They bought it at a public auction. But along with the deed to that physical land came the legal obligation to clean up historical soil contamination left behind by whoever owned it before them.
Oh, wow. So it's a stark reminder that physical assets have physical liabilities. You buy the land, you inherit the sins of the past.
Exactly.
Now, $12 million isn't going to sink a company making $630 million in profit, obviously, but it proves that environmental regulations can suddenly hit the bottom line without any warning.
Exactly. It's a localized physical risk.
Hmm.
But the second detail is much broader and, frankly, much more concerning.
What is it?
In Note 38, which is the subsequent events section, the auditors specifically break character to call out the evolving geopolitical tensions in the Middle East.
Particularly around the Red Sea, right?
Yes, they explicitly note that these macro developments could disrupt the supply of key raw materials, create major bottlenecks in logistics and shipping, and ultimately cause delays in project execution.
Which brings us right back to our original premise. We said looking at this report was like uncovering a perfectly tuned machine.
Right.
The gears are running smoothly, the profit margins are expanding, and the Kickstarter model is funding the whole thing without expensive bank debt. It's brilliant.
But a machine still needs a steady, predictable supply of raw materials to function.
Exactly.
You can have the most efficient factory in the entire world, but if the cargo ships carrying your copper and steel can't safely navigate the local waterways, the factory grinds to a halt. The cash advances just won't matter if you can't actually build the product.
Right. The financial blueprint is flawless, but the physical terrain they are building on is getting rougher by the day.
Very true.
So the provocative thought we want to leave you with today as you go about your own business strategy is this. In a world of increasing geopolitical friction, vulnerable global supply chains, and tightening environmental regulations, how long can a company shield its perfectly optimized high-margin cash machine from external real-world shocks?
It is the ultimate stress test for any physical business today. I mean, you can master the balance sheet, but you cannot control the map.
You really can't. They have absolutely mastered the numbers, but keep a close eye on those supply routes.